Welcome to the Modern Wealth Management Educational Series. I'm Dean Barber, Managing Director of our Lenexa, Kansas office, along with Chris Rett, Certified Financial Planner and Advisor here in our Lenexa office as well. So Chris, we're going to talk today about Charitable Remainder Trusts and Charitable Lead Trusts. And obviously, somebody's got to be charitably inclined in order to want to use these, but we want to try to break it down simple for people so they understand what it is and when it might be appropriate to use these types of trusts. So first of all, welcome and thanks for taking the time to participate in this educational series with me.
Yeah, thanks for having me, Dean. And you're exactly right, is that just like any other tax strategy that we talk about, is that they're powerful when they're used appropriately, right? Is that just because somebody is charitably inclined doesn't mean that what we're going to talk about is going to be applicable to them and beneficial. But at the same time, if somebody's listening to this and saying, hey, this sounds about right, that's what this is geared towards.
Well, and obviously, as people are watching this, hopefully if they think, okay, maybe this is something I should talk about, reach out to us and let's sit down. We'll get you with our CPAs and we'll get you with our CFPs, and they can collaborate together on your behalf and figure out, is this something that actually makes sense for your overall plan?
You're exactly right. And so, but because of that too, is that if this is just like anything else, is these strategies we're going to talk about today are very powerful when used appropriately.
So we thought we'd do this towards the end of the year here because according to a website called nonprofitsource.com, 30% of charitable giving occurs in December. So we thought, okay, well, let's talk about charitable giving maybe in a different way, giving in the name of a trust. And of course, Giving Tuesday is on December 2nd. So charitable trusts are a way that, especially a charitable remainder trust, Chris, is a way that people can give money to a trust who the ultimate beneficiary of that trust is going to be a single charity, or it could be a number of charities. The trust itself spells out what charity or charities will receive the final proceeds, right? The remainder proceeds. And the reason we call it a remainder proceed is because there can be an income beneficiary on that charitable remainder trust. So I've seen it to where niece and nephew were income beneficiaries for as long as they lived from an aunt. And then once both the income beneficiaries have passed away, then the charity winds up getting. I've seen it where the original donor, the person who's giving the asset to the charitable remainder trust, is the income beneficiary until they or their spouse or both have passed on. And then the money goes to the charity or charities. So there's a number of different ways that charitable remainder trust can work. But the idea is to be able to get an immediate tax deduction for, and the tax deduction is a calculation. It's the net present value of the future gift. So depending upon a number of different factors, and this is where your CPA will really come in and help say, okay, here's what the upfront tax deduction is for doing this. And then obviously you take an income out of that trust while you're alive. The income beneficiaries will pay tax on that income as its ordinary income, capital gains, dividends, etc.
Yep. And then, like you said, the charity gets it at the end. And so it's kind of a win-win approach, is that, hey, the donor gets the upfront tax benefits immediately today, right? When they put it in the charitable remainder trust, they get to live off the income,
right? And
then the charity gets the money at the end. And so really is that win-win of getting to be able to use the tax benefits, now, still not say, hey, I'm going to give away the money now. You can still use it for your own benefit. Like we talked about, is that you can either get an income stream as a dollar amount or a percentage. Typically, and I don't know what you've seen, Dean, typically what I see is a percentage of the account, and then the charity gets what's left over, the remainder.
That's exactly right. And so that's the charitable remainder trust. And we'll go into a few examples here as we go throughout this educational series. There's also the Charitable Lead Trust. And the Charitable Lead Trust essentially is just the opposite of the Remainder Trust. The Lead Trust, you put the money into the trust, and the recipient of the income from the trust is the charity. And then for a specified period of time, so it might be 10 years, it might be 15 years, it might be 20, or whatever the number is. And then ultimately, the remainder beneficiary will be maybe it's children, maybe it's grandchildren, right? So the charity gets the income, but they don't get the principal. So it's the opposite, right?
Exactly.
Where the charity gets the what's left over, the principal, and the beneficiaries, the income beneficiaries would have been most likely relatives.
Yep, that's exactly right. And so somebody that this might be considered for is that, somebody that is first charitably inclined, right? Is that I think this would be a good category of saying, hey, if you've utilized QCDs to the max of their ability, or you've used donor advised funds and you're looking to step that up, or Dean, is that you and I were talking about example you came across recently where there's a highly appreciated asset that maybe somebody doesn't want to pay taxes on, and they don't need that money, and they are charitably inclined. This is going to be that type of demographic where it's going to be really useful for.
Yeah, no, it's right. And again, there's certain rules that have to be followed when you do these things, but there can be major benefits. So one of our other managing directors, Marty James, who's our lead CPA, and he's the managing director of our Indianapolis office. He's going to join us here for just a second. He pre-recorded this, so he's wearing short sleeve shirt. You and I are wearing long sleeve shirts, so obviously he recorded this at a different time than us. So let's listen to a case study where Marty James used a charitable remainder trust for one of his clients.
So I had this client that she's in her later 70s, and she's very charitably inclined. As a matter of fact, she wanted really all of her money to go to charity, and her husband's money was going to go to the kids. So we thought we'd take advantage of some of this now and actually, fund a CRT with some money that was in a revocable trust of highly appreciated securities. So we transferred those securities into the trust. Nothing special about the way it was set up. And then the trust was set up to pay out, approximately 10% per year back to her. Well, what a lot of CRTs will do, because typically you're using a CRT because you have a liquidity event happening. Here, we took existing securities, dropped them in, and we didn't sell them. So there's really no capital gains or anything coming out as her distributions. So when her distribution does come out, we do have dividends and such that the things are earning. We were actually distributing the securities back in kind back out to her to a revocable trust. So there was never really any capital gains recognized. And then what will happen, when and she has since changed her mind. Now she wants money to go to the kids. So the kids will now get a step up in basis in this money that's in a revocable trust. So it's kind of a unique way. Instead of actually sending her cash out, we would actually send securities, in kind out as part of that distribution, and then shore up the actual amount with some of the dividend money and cash that was actually in the trust. So it's worked out pretty well, so far. And it's doing just what we want it to do.
So this is interesting, Chris. So if you know Marty, Marty has, I don't know how many times he's been quoted in the Wall Street Journal. This guy's in a lot of articles. Think about what he just did. Mm-hmm. He got the tax deduction for the net present value of the future gift. Okay, and that was going to be a pretty big tax deduction because this lady's in her late 70s.
Sure.
Didn't sell the asset.
Yep.
So the securities coming back out, no tax liability on the securities coming back out.
So didn't sell it when put into the charitable remainder trust, and didn't sell it when they took it out. Yeah.
Exactly right. So she got the deduction for the money going in, and then the money coming back out is non-taxable because it's still just securities, right? Mm-hmm. And then when she passes away, whatever's in the revocable trust, not the charitable remainder trust, but whatever has come back out of the charitable remainder trust to the revocable trust, her children will get a step up and based on that. So it's a beautiful way to use a charitable remainder trust. It's nothing I've ever done before, but I love the way that Marty put that together.
No, exactly. And you can see now the win-win-win-win is that the final piece is that step up in basis. Very well done by Marty, and you can see why he's been as successful and quoted as much as he has.
That's right. Now, I have another interesting one, and it involves a husband and a wife. And in this particular case, the husband owned a building where his business was, and he wanted to give that building to his alma mater. Mm-hmm. He thought that where he went to college, he thought that they could use the proceeds from that building, so he was going to give the building to the college. And his wife's like, there's no way we're giving that building to the college. That money's going to go to our 3 boys. And, of course, I was there, and I said, look, you can do both.
Yeah.
You can do both. And they're like, okay, explain. And I said, look, we have to involve 2 types of trust. So we're going to introduce a 3rd type of trust, and that is an irrevocable life insurance trust, also known as an ILIT.
The ILIT, yep.
All right. So in this case, what we did was we gifted the building to a charitable remainder trust. We allowed Mr. and Mrs. to be the income beneficiaries from the building. So they didn't sell the building. They just went ahead and continued to get the rents from the building. So as long as the two of them are alive, they get all the income from the building. And then when they pass away, the building goes to the alma mater. Well, where does the irrevocable life insurance trust come in? The income from the building, we use probably 35 or 40% of the income from the building to pay for a second to die life insurance policy, which means that the life insurance policy doesn't trigger or be paid until both spouses have passed away. So the income comes in as long as either spouse is alive. It's paying the insurance premium with only a part of the rents. And we did that policy for the same value as what the building was appraised for at that time. Right? So it was approximately a $3 million policy.
Yeah.
And each one of the children, so both mom and dad have since passed, and each one of the children got their $1 million tax-free because it was inside of an irrevocable life insurance trust. And because it's in an irrevocable life insurance trust, it's removed from the taxable estate. So it's not possible for it to be having estate tax, either state or federal. And then the alma mater wound up with the building. So here we got a win-win-win, right?
Yeah.
We got a tax deduction up front. We were able to do some Roth conversions.
Yep.
We got income, right?
Yeah.
And we got tax-free money going to the children, and we got charity receiving a building that they can then sell and use.
That's what I was just going to say, is that when done appropriately, everybody wins, and there's a lot of tax benefits when you're doing this.
There's one person that gets left out.
Yeah, there is.
There is.
And I don't think people are going to complain about it.
Yep. Uncle Sam gets left out.
Yep.
Yeah, but so there's a scenario where one person says, hey, I really want this to go to charity. The other person saying, no, I really want our kids to be able to get this money. So just because you're using the Charitable Remainder Trust, Chris, I think what people need to realize is as long as you're healthy and that Charitable Remainder Trust can kick off some income to pay for an insurance policy that then goes inside of an irrevocable life insurance trust, it's a beautiful thing.
No, it really is. And that you mentioned that health component of it, but it really is a way, Dean, is that you can have your cake and eat it too, is that you can both give to charity, you can live off the means if you need to, or if you want to, and in a situation like this, both parties win. Is husband and wife in this scenario wins, which is a really great thing, and the college gets the property when it's all said and done.
So it's perfect.
Yep,
absolutely perfect. All right. So you got any examples, Chris? I got one more that I think is interesting.
I was going to say I do, but I think yours is much better. I think we look at that one as an example. You're talking with the land.
Yeah, the land. So as you know, Farmland, a good long-term buy and hold investment, has made a number of people extremely wealthy. Well, I happen to have a client that several years ago, his family had a farm. The farm came to him, and he was just like, Dean, he's like, I'm not getting to this farm anymore. It's really not generating much income. I think at the time it was maybe 1.5% or so of the appraised value of the farm.
Yep.
And he's like, I think I'll just go ahead and just give the farm to charity. And I'm like, well, I go, hold on, let's think about this for a little bit. And so one of the things that works in the Charitable Remainder Trust is if you give the farm to the Charitable Remainder Trust and then you sell the farm, there's no tax liability because it's inside the Charitable Remainder Trust already, right?
Yeah.
So we were able to go ahead and sell the farm inside the Charitable Remainder Trust and then invest the proceeds to produce income for he and his wife, as long as either one of the two of them were alive, right? So they're the income beneficiaries.
Right.
And we did the same thing. We took the value of the farm. We were able to do a second to die life insurance policy, but the income that they were getting from the investments after we sold the farm was about 3 times more than what they were getting from the farm after we paid the insurance premiums. So they got more income, right?
Yeah.
Charity winds up with the money in the end, and and the kids wind up with tax-free money coming from an irrevocable life insurance trust.
Well, and to your mention is they deferred the taxes when they put it into the trust too. Is that, you're deferring taxes, you're or I guess to say minimizing taxes on what would otherwise be a fairly large capital gain. I mean, we're talking sometimes in the upwards of millions of dollars or tens of millions of dollars, depending on the type of property or appreciating asset. But then you're reducing tax liability, you're creating great wealth transfer, and the charity gets the money and you're reducing taxes. Dean,
that's great.
Hard to find a loss there.
There's a lot of things that you can do if you're charitably inclined. One of the things that we're talking to another individual about today is setting up a family foundation, and I've got a number of clients that don't have children, and so in this particular case, we've got a client who's got a fairly large IRA, and we're trying to, and we're like, okay, well, do Roth conversions really make sense for this individual? And he's very charitably inclined, and so is his wife, and so like, let's talk about a family foundation, and maybe we set up a family foundation, and that family foundation is the beneficiary of that IRA ultimately, and then that family foundation names nieces and nephews to run the foundation to get paid to then give that money to charity over a period of time, right? So you could pass on that charitable, kind of mindset to the next generation as well.
No, that's exactly right. And I don't think enough people really recognize that that's a possibility. So again, I think if you're listening this, to your point earlier, Dean, is that, hey, if you fit this category, if you've got, large capital gains that are unrealized in assets, or if you have a large IRA that you don't quite know what to do with, is that there are tax benefits that you can do, but you can also check that box if you are charitably inclined.
Right, but look, you can do it other ways too. So remember I told you I have a niece and nephew, met these folks back, it's been 18 years ago now. Their aunt passed away, had set up a charitable remainder trust, and the niece and nephew were the income beneficiaries. And so for the last 18 years, the niece and nephew have been getting income off of this charitable remainder trust. When both of them are gone, then the charity ultimately gets it. So this was one that was done and triggered at death. It wasn't one that was set up prior to death. So there are a number of different ways that you can do this. So if you're thinking, all right, well, maybe I would like for niece, nephew, et cetera, whatever, just any example, to get the income from this while they're alive. But ultimately, when everybody that I care about is gone, let's give that money to charity.
Yeah.
That's another thing and another way that you might want to think about the charitable remainder trust.
Or if you have highly appreciated assets and you're saying, I still want to reap the benefits of that, and saying, hey, you donate to the charitable remainder trust, you peel off, call it 4, 5, 6% of the charitable remainder trust for your own needs or benefits or wants, and then the charity gets it when you've passed.
And maybe that highly appreciated asset is one that doesn't kick off income.
Yeah.
And so you just want to be able to get income, but you don't want to pay taxes on it. And then in that case, you may not give all of it, but you may give a portion of it so that you can generate income from that highly appreciated asset by selling it within inside the charitable remainder trust. Anyway, number of different ways that people can use these things.
Absolutely.
It's important that you have a good certified financial planner.
Yes.
And that certified financial planner is working hand in hand with a CPA, which is exactly what we do here at Modern Wealth. Chris, thanks a lot for taking time to come in and talk to me about Charitable Remainder Trust for our Modern Wealth educational series.
My pleasure, Dean. Thanks for having me.
Thanks again for joining us, everyone. As usual, if you enjoyed this information, please share it with your friends and make sure that you subscribe.
The views expressed represent the opinion of Modern Wealth Management, LLC, an SEC-registered investment advisor. Information provided is for illustrative purposes only and does not constitute investment, tax, or legal advice. Modern Wealth Management does not accept any liability for the use of the information discussed. Consult with a qualified financial, legal, or tax professional prior to taking any action.